Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hello, everyone. Welcome to Vantage Point with True North Wealth Partners, Episode 7. I'm Andy Smith.
Eric Susie.
Happy
New Year.
Back at it.
Yeah, I tell you, what a year last year was.
That's right. What do you mean? What are you talking about?
That over with yet. Strap in. We got more volatility and mayhem for another 2 years.
Yeah, more than likely. Yeah, well, good. So had you have a good Christmas and New Year?
Yeah, we did. Thank you. Yeah, the family's good. So far, knock on wood, healthy. Doing all right. How about you? Your family?
Yeah, same. Yeah, probably, didn't do much. Stayed home and,
It was low key.
Very, thankful, though, to be healthy and, no complaints.
I hear you.
So what's going on? What's new?
There's a lot of news. We got a lot of stuff to cover today. So we're going to start off a little differently. So folks, clients, when you're seeing this, so today's Friday the 15th, but the drawing for the Mega Millions and the Powerball, one's tonight, one's tomorrow night, Saturday night. So combined, it's roughly, I'll round it up, 1.4 billion. So combined, 1.4 billion in possible winnings is there. So with that said, hopefully one of our clients or listeners wins. So that would be great. Best of luck to you all. Get out there. You know, it doesn't hurt to throw a buck or two at the gambling machine. Go to a lot of news as far as the football game, OSU. You know, I'm an OSU grad, you're a BG grad, but my point is you're a Buckeye fan too.
Sure.
So with the Clemson game, great game. Mm-hmm. I just wish that we showed up and played like we played for Clemson as we did. So Alabama, Roll Tide, they did it to us in the second half especially. But what'd you think?
Yeah, it's disappointing, but yeah, it's hard to know sometimes what you're going to get with some of those games.
The matchups, I know.
Yeah, I mean, especially with this year being so wacky, and they really, but yeah, I was glad we were there and part of the game.
We represented well. So
yeah,
Buckeye Nation, good job, way to go, Bucks.
Yeah, next year, right?
Yeah, we can always hope and pray. Amen.
So, and Urban's heading down the warmer weather. It looks like.
Yeah, Mr. Florida man, Urban, we're gonna miss you. Thank you for all you've done for the school systems around here, and and helping out and the kids and the churches, and so appreciate that. Do well. We wish you well, and he has that itch in him, so he couldn't be tied down and get back to coaching. So
yeah. Got to make hay while you can, I guess, while your name's still good out there for a few more years.
Yes. Amen.
Good for him.
Yeah. As far as, the COVID, obviously still dragging on. You'll see here on the list, the USA still spiking up. So we're still grinding higher, as you can see it. Now India has now turned down. Brazil's turned down. Mm-hmm. So hopefully, again, the foreign countries started earlier. We're bringing up the rear. Hopefully this is the last little wave. Springtime, 2 more months. We got the vaccines, so get through this and then move onward with that.
Yeah. Then there's the good news too. There's some more vaccines in the pipipeline.
Yes, thank God.
So instead of 2 being approved, there's a third one that just got approved. And
what's the firm name? Is it J&J? Was it?
Yeah, I think Johnson. Yeah, they have one in the pipeline. So one supposed to be a one and done, I think, or one prick. Yeah. Vaccine as opposed to the 2 that are out there with Pfizer and Moderna. So and there's a bunch more. There's there's still 43 other vaccines in phase 1. So there's about 3 phases. They go into limited trials, it looks like, and then they have to get approved by the FDA obviously before they get rolled out. So hopefully things continue to roll out and the states do a better job, I guess, at getting some of that stuff out there so people can get vaccinated.
Good. No, I hear you. So that's the latest on that. And then as far as got to talk about the elephant in the room, and no, it's not the blue sweep. It's overall market performance and
crazy market.
The crazy markets last year, and I think more volatility this year is what we anticipate. So it's going to be interesting. So just in general, to sort of recap and give you some perspective on how certain firms, advisory firms, and companies did. So Berkshire Hathaway, you've heard of them. They have a Class A share. So the Class A share is only up 2.4%. So, those are the folks, most money, brilliant minds, what have you. And so that's 2.4. Even our, within Stratus, the Fundamentum, we use them. as well. So Fundamentum, they announced, they put out the publication as well. Just read a little blurb here if you don't mind. So where Fundamentum, their strategies also lag, they mentioned here. This is their fourth quarter 2020 review I'm reading from. So they lagged. Their benchmark is largely explained by an approach that proved to be too conservative given the quick recovery and the fourth quarter rally. So as always, we place more emphasis on protecting the downside than shooting for the best case outcomes. That mindset hurt relative performance in 2020 in many of their strategies. So, you heard my clients, our clients, we've heard us say, turtle versus the hare, who wins the race, the turtle. So, last year we definitely, the cash was a drag and is what it is.
Yeah, diversification is boring, right?
Yeah.
So it's not, you're not going to, if everyone was in Amazon and Netflix.
The FANGs.
Tesla up 700% last year. So it was kind of a crazy anomaly. Year. But kind of a funny story though with Berkshire.
Yeah.
So I worked at Schwab. I was a trader for them.
Yeah.
We had our own. Schwab has their own line for Berkshire halfway stockholders. Yeah.
Are you kidding me?
So they're at the time their A shares it was like $125,000 for one share.
Wow.
And so Schwab, they were afraid that a trader would fat finger or put in the wrong amount of digits on the trade. So there was like a select group, had their own group for just trading Berkshire shares. So it was kind of funny.
That's a good story. I wasn't aware of that. So thanks for sharing that one, man. But just also to recap briefly, what you're seeing here now is the trade volume. So with trade volume, summarizing 2020, you'll see the average trade volume last year was actually right around 5 billion trades a day. So that was 5 billion trades a day. That's the red line going across. You can see relative to February, March, April, then some spikes in June. We're at 8-9 billion trades a day. That was the virus and the shutdown, et cetera. At the end of the year, you can see how it tailed off, very low trade volume, around 3 billion or so trades, et cetera. So I always like to do that because just visually, it's Monday morning quarterback. You look back, but in the thick of themes, while you're in it, it helps provide, okay, where are we is momentum. Mm-hmm. So, do you want to buy or put new cash in at certain times of the year? And then the green line, the corresponding line, y-axis, it is. So on the y-axis, it's the 0 to a 1. A 1 means a sell. It's the most greedy-ish. Mm-hmm. So you can see back in early January there, we're up at 97, which is that 1 range. And then we ended the year, around the 0.5 range. And currently right now, it was 66. So in last week, it was in the 72 range. So we're burning off some of the excess froth, and that's what we were talking about earlier, a little bit of froth built into the market. So near term, we expect still a little bit more burn off sideways trading, and that's normal. So again, buy low, sell high. These are just things that help us. And you can see, again, going back to trading volume, it was up 34% versus 2019, which is 3.7 billion trades versus the 5 billion trade average.
And why is that?
That was just because of the freakness of the COVID. So the shutdown, people freaked out, which brought the averages up. Now,
so more accounts.
Okay. Yeah, you bring up a good point too. I mean, there's with the COVID, people staying at home, they opened. I heard over 10 million accounts were opened. So that led to a lot of people trading as well and trade volume.
Sure.
And then this year so far, we're down. We're only doing about 4.9 billion trades versus the 5 billion average daily trading last year. So we're down 4.9 billion, which is down 1% so far year to date versus last year. So again, just something I track, learned at T. Rowe for all these years, and always something to consider. In regards to the overall, small trader call buying, again, this I looked for a more current updated one. This is through January 8th, but right now it's 0.49 the reading, and with this reading, it's we're back there in the over excess above the red line. So again, we're looking for a little bit of a breather, what we were talking about earlier. And this is just due to call buying is folks who are just buying options or calls, anticipate markets going up.
And what's that? What's a call option?
It's just calls and puts. So it's pennies. It doesn't cost much to buy options. They're very volatile. We don't use options, but call up, put down. So that's what people are just placing bets on what they foresee the market, and then we're excess of where we no one stays that high forever. So again, we anticipate a little bit of a sideways / burn off coming too. In regards to the SPY, which is the S&P 500 index, the breadth. So you and I have talked about how in earlier episodes over the summertime, there's 5, 10 very narrow market leadership. Well, now it's finally opening up. So the breadth is opening, which is good for the overall economy.
Yep.
So that's great. And as you can see here on this report, again, we're at 90.42. This is as of yesterday's close. And again, the breadth has excess breadth. You ride those ponies. So we've been riding the markets. Small caps have done well of recent, things of that nature. Things that were underperforming has bounced back. So again, we just mentioned this, and this is near all-time highs since I believe the past 10 years or so, as far as the breadth. So things don't stay there forever. And one gentleman is from Morgan Stanley, Mike Wilson, points out that 92% of the stocks in the S&P 500 have extremely strong breadth. Historically, this metric has have difficulty moving even higher. Since they're already at the 98th percentile. So what that says, if history holds, Morgan Stanley expects this metrics to turn lower. So again, pull back, which is normal. Things are a little elevated and sort of things to come.
Yeah. So the breadth could be seen as, so when you say breadth, like last year we had just a handful of tech stocks, pretty much pull the market up. So this year we're starting to see more companies participate, right? So that tells us
widening.
That more companies are performing and doing better, and that's obviously what we want to see.
That's exactly right. So, then you're getting back to a true economy, one that could sustain itself around these pockets of euphoria, because we had the K economy. So half the K is half the economy did well, the other half still in the hurting. And we're still there now. We're not out of it yet. So, but seeing the breadth as a first good step for that opening of the economy. Now, with the shutdowns, the recent shutdowns, a spike in the COVID and the virus and all that, we need to get through this. That's why another month or two, hopefully, and then we'll see the things kick in a little bit later on. Speaking of the breadth, so Larry Williams, another person we use as a strategic partner for our research, Keith notes he's following in 2021 would be the Federal Reserve policy, interest rates, cost of energy, stock valuations, cycles, patterns of the past, and then just pure raw emotion, he says as well. And his projecting out over 60 plus years in the industry, early March might be a good low or a pull-in time. So expect sideways / market volatility between now and March, and that's normal. There's a lot of news going to be coming out over these next 2 months, and the new regime and just policies in general.
Yeah, just started earnings season.
Earnings. Yeah, today they kicked it off. So for the next 5 weeks, there'll be earnings rolling out. So some good, some not so good. But sometimes they sell on the good news. So that's what's sort of happening,
Yeah, a little bit.
Which is normal as well. Also like to talk about the dollar. So the dollar is sort of not necessarily overlooked, but it's something that's important. It's a leading indicator as far as you get the dollar right. As our Hedgeye research partner says, you get a lot of other things right. So the dollar peaked out, as you can see, in April of this year. It was about 105 or so, and then it's gone down ever since. Now this was through the end of the year. It was about 89.94 was the dollar. Right now it's right around 90, a little over 90. But what they and many folks anticipate is the dollar to continue to go down and weaken. With the flux of the 1.9 trillion that they're asking for with the new regime and all that. So we'll see. We'll try to skinny that down. But that's going to overall weaken the dollar. Now, to the flip side, what does well in a dollar decline is EM, emerging markets, international. So that's why we've overweighted that asset class. We've completed the models. Now that we have an understanding of where to put certain asset classes to full rebalance, will be finalized here next week as well. So you'll see a lot of activity in that time period. So you have the dollar, you have commodities. So with commodities, that should do well as well. In the quad 2 that we're in, going back to Hedgeye, or one of our trusted research partners, strategic partners. So first half of the year, we're in the quad 2. And then again, 1, 2, 3, 4, spring, summer, fall, winter. Quad 2 is a good place. You higher growth, higher inflation. So inflation's coming, commodities, we see that now. So, corn, cotton, soybeans pretty much are all on the top end of the risk range, excessive risk right now for those. But, that'll be with us for a little while. Mentioned unemployment rate, rate, thank God's coming down, like 6.7 should be down. I think, Argus, one of our strategic partners, they mentioned it should be down in the around the 5% range by the end of 2021. That'd be fine. Other people have it hedge eyes about 5.5%. So again, the point of that is unemployment's going down. So that's good. You want that. That helps the economy.
That's right. People going back to work.
Yep. Got to open up. GDP. So GDP for 2021, about 3.7%. Again, coming from Argus and many of other firms, but 3.7% is expected GDP. Some of the firms are higher, research firms, some a little lower, but just to give you, where we're coming from, 2020 is 0.7. So we might sneak out a positive GDP for the year. We'll see. But 0.7, that'd be great. So if we can sneak out a positive one. The nowcast for GDP, again, it's the Federal Reserve Bank of Atlanta, the GDP nowcast that we follow as well. Right off the ticker for today, 1/15, 2021, GDP fourth quarter is 7.4%. So GDP growth rate for fourth quarter is 7.4%. So that's great. So that's, again, a strong reading as well. So that's just hot off the press.
What's the biggest makeup on GDP? Or what's the biggest factor, the biggest contributor?
Multiple things such as,
spending.
70% consumer GDP is tied to spending.
So it's kind of like all the stimulus checks.
Yes. So that's why GDP should be good, because there's more stimulus checks coming. So we anticipate, again, artificially inflated. The government is backstopping everything. They're buying $120 billion a month in mortgage-backed securities and treasuries. So that's keeping that market going, and they're continuing to buy $120 billion a month for the foreseeable future. So you have that going. You got the Fed rates keeping low for years to come, but rates will go higher. Like I mentioned, remember last month, the 10-year has already crossed that 1%. It's going to be 1.25 soon, off to the 1.5. So rates going higher. So you have to be mindful of that too.
Yeah. What's our national debt? Was it 25 trillion?
At least. Yeah.
Call me when it's real money.
Call me, right. Yeah. I know what you mean. Oh, boy. So, we talked about a lot of things today. GDP, cash. There's still about $5 trillion in cash in the sidelines. There's still more money to come in. So, that's good. Again, 2021 should be a good year. We mentioned high single digits in the S&P. Other firms mentioned higher single digits as far as in the teens, 12, 15%. But we're saying 8 to 9%, S&P 500 returns. So a good year, positive, still going to be volatile. A lot of action still out there. As one last point I would like to make is just briefly talk about, this may have not been picked up on many headlines, is the healthcare. So it's called the Haven Healthcare. So it was a venture partnership here with J.P. Morgan, Amazon, Berkshire Hathaway came together 3 years ago to try to, hey, how can we tackle the healthcare crisis going on? When they mentioned this back in January 2018, the healthcare industry went down about 4.4% in one day. When they mentioned that they closed it here and earlier the first week in January of 2021, the index rose 2.2%. But my point is this: it's very hard to get this, and this study has concluded that it's very hard to try to get this rolled out, and how difficult tackling healthcare is. But the three companies have been doing this and testing it on their own folks as far as their healthcare. So even I'll mention I know someone who works there at the J.P. Morgan, and they're doing a flat fee for service. So that was rolled out last year. So as an example, if you have hospitalization, if you're admitted to the hospital, it's a flat $1,000 charge, no matter what it costs. So, if testing, a flat $100 charge. So things of that nature were being tested, and an internal memo went out from Jamie to the employees saying that, hey, yeah, we shut it down, but there's more things that are going to come over the next few months. So more to come on this. They took a stab at it. It was challenging. They're still going to continue to talk and try to work things through, and something which it is something will good come out of this, and HSAs are still viable accounts too.
Yeah. Did I ever tell you I had a dream that I got interviewed by Jamie Dimon?
No, let's hear it. This ought to be fun for you folks.
Yeah.
Let's hear
I
it.
was in his office, and he's literally, his face is like this, and he's asking me questions. He's interviewing me. And I can only remember, he kicked me out of his office.
Oh, that's
all
it?
I remember.
That's
yeah.
it?
So
Okay.
I don't know what that means. But.
Oh no! There you go.
All right, so good stuff there. So what's next on the plate? We've got
So our strategic partner, Robin Harriman, will be joining us next, and she's helped many of our clients over the years, and for tax planning and strategies, and we'll talk about her and Ken as well. So
Very
looking forward to that.
All right.
This month's strategic partner, Robin Harriman, with Robin Harriman EA Tax Services LLC, is not affiliated with True North Wealth Partners or Stratus Wealth Advisors.
Welcome back, everybody. Thank you for joining us. Our strategic partner for this month of January is Robin Harriman. Thank you, Robin, for joining us.
Thank you for inviting me.
Yeah, no, it's been a pleasure. Robin and I, we've known each other for about 20 years now, so 2001. So we go back a long ways. For full disclosure, Robin is our tax specialist, and she's been doing my own personal taxes for 20 years now. So thank you.
You're welcome.
And so we're all good with that. And Robin is also here within our office, and she also has a cohort, let's call it, Ken Ruslett, and he also has been working with Robin, yourself, for about 20 years. And I guess maybe just unpack that a little bit and tell us more about yourself and Ken's role too.
Well, thank you for inviting me. So you'll hear the accent. So I'm born and raised in Maine. Still talk to my folks every day so I could have an accent.
My lobster.
Yeah, I do love my lobster. So I lived in Indiana before, New Jersey, Missouri, and I moved to Ohio in 1999. I started doing taxes when I was 15 years old.
Holy cow.
That is when my dad, for school to graduate, one of the requirements was to do a tax return. I did my parents' tax return. Their accountant who came to the house did the tax return. I got my parents back more money. My dad fired the accountant, and since 15, I've been doing all their tax returns.
That's great.
So, yeah.
What a story.
It is a cool story.
Classic.
So in 1998, I decided to do it professionally because I like it so much. And I started working for H&R Block. In 2005, I became an enrolled agent. In 2008, I got my accountant degree. And in 2014, I started my own tax business, which is Robin Harriman EA Tax Services. And then
Excellent.
In 2019, I joined the offices here and have loved it ever since.
Beautiful. Yeah, it's been great. So we appreciate that. And our clients have it's worked out well. We try to be internal clients that have utilized Robin and Ken, one-stop shop. So we have internal partners, strategic partners such as tax, mortgage, obviously Medicare assistance, et cetera, insurance and all that. So what does EA mean? Unpack that.
Okay. So enrolled agents, EA, are American tax experts. We are the only federally licensed tax preparers who specialize in taxation and have unlimited rights to represent you in front of the IRS.
That's important.
So
right?
It is important, and we're very proud of those letters.
Awesome. No, I appreciate that. That's great. What are things like, I guess, taxpayers, what should they consider heading into 2021? What's on the horizon here?
Okay, there's 4 things I like to highlight. The recovery rebate credit, the refund interest, unemployment benefits, and the $300 charitable contribution. Right. So going into it, the first thing is the recovery rebate credit. Most people understand this from the economic stimulus payments. So in 2020, some people received full, some didn't receive, and some got partial. That was a $1,200 for single. That was $2,400 for married, and there was $500 for the additional for each qualifying child. Okay, that was based off of 2018, 2019 tax returns. Okay, but it relates to your 2020 tax return income. So some people didn't quite qualify for it, okay? This is when the credit trues you up for it, okay? Some people had higher incomes in 2018 and 19, and with their income in 2020 don't qualify, okay? And so they, through December, the CARES Act that was passed in December of 2020, you do not have to pay it back.
Okay, beautiful.
So that's good to know, okay? So it's really about truing up. You're going to need your Notice 1444 from the IRS with the exact amount that you had to do your tax
That's
return.
a lot of fours.
Yeah.
1444.
It is a lot of force. The next thing I want to talk about is the refund interest. So your tax return was due April 15th of 2020. They extended it to July 15th, and then extensions went to October 15th. Okay, if you are entitled to a refund, then the IRS by law has to pay you interest, okay? 13.9 million people received checks, okay, for interest. Average of $18 per check.
Oh, boy.
The IRS will, and what's unique about it is they sent it out separately, the interest payment and the check. Okay, so, but the IRS, when they pay you interest, they expect it on the tax return. They'll send it out for $10 or more, and that's a 1099 INT. But for under $10, you're still required to report it because it is taxable income. Okay, so if you got a direct deposit, you would have had two deposit informations, okay? One for the original refund and then your interest. So you need to know what you received for interest to be able to prepare your tax return.
That's a lot of minutia there in the details.
Yes. Let's talk about unemployment.
Yes, that's a biggie for this year.
It is a biggie for this year. So 2020 unemployment is taxable. Okay, some people took the 10%. So when you signed up for the unemployment, you were able to take 10% is the most that they would withhold for federal refunds, federal checks. Okay, now you need your 1099-G from the unemployment from your account. Okay, to be able to do your tax return. Okay, so you need to get that. They're not quite up on Ohio yet, but you need to go into your account to print that. You also got to remember, if it's taxable to the federal, it's taxable to the state. Yeah. And a lot of people probably will be owing the state. So be prepared for that.
Man, there we go.
Yeah.
Right to get that checkbook out.
Okay, and last but not least, an exciting one, I think, is the $300 charitable deduction that you can do on the front page of the 1040, whether you itemize or not. So when the IRS says cash contribution, they mean by check, credit card, or debit card, okay? Not clothing, just by those means, $300 on the front page. So when you decrease your federal taxable income, that helps your state, so it lowers your state, okay? Yes. If you do itemize, then anything over the $300 goes on your Schedule A itemized deduction.
Gotcha. Well, I guess what else should we consider or talk or think about and prepare for 2021 taxes, so we're getting it all together?
Well, in 2020, RMD, the required minimum distributions from the IRAs, okay, there was no requirement, no minimum.
Thank you, CARES Act. That was good.
Thank you.
Yeah.
But it is still on for 21.
Right.
Okay, as it states now.
Yes.
So, and then another thing, if you do a health savings account, health savings accounts I really like. Again, takes away from taxable income, helps on federal and state. Okay, but there is now over-the-counter drugs for and over-the-counter and prescription for menstruation and genital tract issues. That's all I'm saying. Yeah. That you can take away from taxable income.
Funny, I have heard that. You read every year they seem to open up the what's allowable, I should say. So I stumbled onto that as well. So that's a good catch and good for bringing it to your attention there. So I guess wrapping up, what would be the due date? Is it the same or has it changed, or where are we for the due date for taxes?
As of now, it is April 15th, 2021. Okay. So a couple of things I want you to think about that the IRS is talking about is if you are due a refund, don't spend it before you get it. Everything's going to take longer to process. They're saying 21 days for refunds at least, and there's certain things that if you have credits on your tax return that they're going to look at and review even more. So there is an app that you can download to your phone. It's called IRS 2GO. And you can check once a day to see where your refund is.
Beautiful.
Okay. Now, if it tells you that it is deposit, because the fastest, quickest way to get your refund is direct deposit, e-file and direct deposit. If it says it's direct deposit, you need to check with your bank. Banks, they have 3 days before they have to release that money into your account. So don't spend it before it's in your account.
Good points.
Okay.
Yeah, very good. Well, that's awesome. Anything else top of mind? Or?
So something I think is very interesting, and this is just going live right now with the IRS. It's called a IPP identification number. And so it's a 6-digit number that is used to do your tax return, okay? This was only open to identity theft victims, but now they are opening it up. You can opt in for anybody. Beautiful. It's another way to protect your identity. You would do this now for your 2021 tax return that'll be due next year. So
That's
it's
great.
something very interesting that people should look into.
It's like a second authorization or a token, that's a great way to do it. So I'm glad to see the government getting up to the times because there's a lot of fraud and hacking going on. So
Unbelievable.
No question about that. Well, great. We do appreciate you and helping our clients and our friendship over the years. And thank you for that, and Ken as well. And folks, there you have it. That's from the tax expert. So prepare, do your homework, get everything laid out. And Robin and Ken, if you need their assistance, please reach out to them as well. Thank you.
Thank you again.
All right, Robin, take care. All right, well, let's end on here. Tips of the month. So tips of the month, let's talk about the client questions that came in and things we've had during our meetings. So
okay. Yeah. One thing that we hear quite often, when you're on your Schwab account and checking the balance or looking at your accounts and looking at the investments in there, depending on the time of day that someone checks the account, you might see movement in some and not in others. And so most of our portfolios have a mix of we call actively managed mutual funds and there's some we call passive or ETFs in the account as well. And we also introduced it's kind of a semi-transparent ETF as well. So I guess real quick, just the difference between those things. So a mutual and actively managed fund it's just a basket of stocks, right? So if you say, hey, I want to own stock, one way to do it is go out and buy McDonald's. Hey, I got 100 shares of McDonald's. If McDonald's does good, my value goes up. If it does bad, it goes down. Or you could say, I want to go buy a large cap growth mutual fund that has 100 different stocks in it, and one of them might be McDonald's. Right. And the other, so if McDonald's is down that day, then hopefully there's enough of the other stocks are up or they kind of offset. So you have kind of this slower growth in a sense with mutual funds. It gives you a little bit more diversification. And there's a team of people who every day they go in and they decide, hey, are we going to hold McDonald's? Or are we going to buy more McDonald's? Or are we going to sell McDonald's? Based on the overall look of the economy. And so there's a team of people that they're making those decisions. And so active tends, we tend to favor a little more active just because there's more eyes on the portfolio as to what's going on. There's more insight into the economy. The other side would be the ETFs or the exchange traded funds, which is more passive. Correct. So there's not a team. It's still a basket like a mutual fund, but there's not anybody really watching it. They just set it up to track an index and set it and forget it. They rebalance once a year for the most part. Yep. Yeah. So so you're going to kind of get what the index returns give you. And so the advantage of that, though, we can use them in a portfolio in certain asset classes where we have it. We have active management kind of offsetting it, so it makes sense, and it kind of helps drive the cost down too internally. And then the third one is the semi-transparent. That's ETF, the most exciting one that we love. It's kind of a newer. I don't say it's a newer product, but it is somewhat newer investment in the sense where it's a mutual fund or it's an ETF. but it's actively managed.
Right.
So it has the good qualities, or the quality we like of the mutual fund, but it trades like an ETF. So it trades throughout the day, like an ETF would. And so it's kind of the best of both. The costs are a little bit less than like an active mutual fund. Right. So those are, I think we'll probably see more of those kind of rolled out here over the next 5 years or so. Yep. Like T. Rowe Price, the one we use, it's the symbols TDVG. It's a dividend growth active managed ETF. But it's the nice thing is it's a newer ETF, but they have a history. So there's a T. Rowe Price dividend growth fund. So it's the same team that manages it. So
that's great. We're really excited about that, and add that to our quiver of bench strength and our arrows that we use for our clients in their portfolios. So that's what we're introducing. And then another tip of the month, clients have asked, Erica, here, the rule of 72. So just to break that and unpack that a little bit. So the rule of 72, just take 72, divided by whatever rate of return you want to take, whether it's 10, 8, 6. I use 6%. So 72 divided by 6 is 12 years. So in theory, if a person gets 6% a year, every year for the next 12 years, the account with portfolio will double from, if you had 100,000, it'll go to 200,000, again, in that example. Now, you and I both know you're not going to get 6% a year every year for the next 12 years. And so with that, that's why we like to use Monte Carlo simulations. So Monte Carlo encompasses the whole history of the stock market, good years, bad years, recessions, depressions, things of that nature, and it's more accurate, and so we use that as well. So those are some tips of the month that clients have asked about, and hopefully we unveiled that a little bit more and unpacked that. And we appreciate you joining our episode number 7 for this month, and appreciate you, our relationship, and we'll actively still be tweaking the portfolios, doing what we need to do over the next few months and quarters as things change and evolve. So stay healthy. Stay well, wear those masks, wash the hands, and we'll see you next time.
Yep. See everybody.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. Investing involves substantial risk. True North Wealth Partners and Stratus Wealth do not make any guarantee or other promise as to any results that may be obtained from this. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No reader should make any investment decision without first consulting his or her own personal financial advisor and conducting his or her own research and due diligence.